If you're in the world of developing clean energy projects, you absolutely need to know about the Investment Tax Credit, or ITC. It's one of the most powerful financial tools out there right now. So today, we're going to break down exactly how it all works.
You know, the whole game really changed for clean energy with the Inflation Reduction Act. It just completely supercharged the financial incentives. And the ITC, it's right at the heart of all of it. We're talking about a huge range of projects, everything from massive solar farms to the EV charging stations you see popping up everywhere.
So let me just ask you this. What if you could get 30% of the cost of your next clean energy project just paid for? That's not some hypothetical question. For a lot of folks, thanks to the ITC, that's the reality.
All right, so let's dig in and break down what this supercharged incentive is really all about.
Okay, at its core, the investment tax credit is, well, exactly what it sounds like. It's a dollar-for-dollar reduction in what you owe in income taxes. It's based on a percentage of the money you put into a clean energy project that qualifies. The whole point is simple. Make these critical investments way more attractive financially.
Now, it's really important to get this. The ITC is not static. It's not a set-it-and-forget-it kind of thing. We're actually in a transition period. Right now, we're operating under the Section 48 rules. But for any project that starts in 2025, we're going to be shifting to the new technology-neutral Section 48E. And that's a big deal because it starts focusing on a project's emissions rate, not just the specific tech you're using.
Okay, let's get into the numbers because this is where the real power of the ITC just becomes crystal clear. We're talking about a 5 times multiplier. Seriously. So, for any project that's 1 megawatt or bigger, the base credit starts at 6%. But, and this is a huge but, if you meet specific labor requirements, that credit jumps 5-fold, all the way to 30%. That is a massive difference that can absolutely make or break whether a project gets built. So how do you unlock that incredible 5x bonus? Well, it all comes down to meeting what are called the prevailing wage and apprenticeship, or PWA, requirements. This is really about making sure these clean energy projects are also creating good-paying jobs. It boils down to 2 things: paying workers the local prevailing wages set by the Department of Labor, and using qualified apprentices for a certain percentage of the work. Now, here's a really important exception you need to know about. Smaller projects, we're talking about those with a maximum net output under 1 megawatt, they automatically qualify for that full 30% credit. They don't have to jump through the PWA hoops, which makes this powerful incentive so much more accessible for smaller scale installations. But get this, 30% is not the ceiling, not even close. You can actually stack additional bonus credits right on top to push the total value even higher. First step, you've got the Energy Communities Bonus. If your project happens to be located in some very specific areas, like a brownfield site or a community that has historically relied on fossil fuels, or even near a recently closed coal plant, boom, you can add another 10 percentage points to your credit. This is all about driving investment right into the communities that are navigating a tough energy transition. And then you can stack another bonus on top of that one. It's called the Domestic Content Bonus, and it adds 10 more percentage points for projects that are built with American materials. This is a huge push to strengthen our domestic supply chain. It means you got to use 100% US-made steel and iron and also hit a specific threshold for other US-manufactured parts. So, with credits that can stack all the way up to 40 or even 50%, who exactly gets to take advantage of all this? Well, the list of who can benefit is actually a lot broader than you might think. I mean, sure, for-profit businesses are the obvious ones, but the Inflation Reduction Act basically blew the doors open for a whole new set of players. Now, tax-exempt entities, think about cities, nonprofits, schools, tribal governments, even churches and other religious organizations, they can all benefit directly. And the way this works is through a truly game-changing new mechanism called elective pay, or you might hear it called direct pay. See, since these organizations don't have tax bills to reduce, elective pay lets them get the full value of the credit as a direct cash payment, a check from the IRS. This is absolutely revolutionary. It turns a tax credit into direct funding for their clean energy project. Okay, so as incredible as all this sounds, it doesn't come without some pretty major rules and risks. The fine print here is extremely important, so you gotta pay attention. One of the biggest risks you have to be aware of is this, the 5-year recapture rule. It's basically a clawback. As you can see on this timeline, if you sell the property or it stops qualifying for some reason within 5 years, you have to pay back a portion of the credit. And it's a steep penalty. In year 1, you're paying back 100%. That amount goes down by 20% each year, but it's still a significant risk you have to manage for the first 5 years of the project's life.
And this quote from Plante Moran just perfectly sums up the challenge. The process necessary to navigate and document compliance can be complex, and the potential costs of non-compliance can be severe. And they're not kidding. From tracking every single wage to sourcing all your domestic materials, the record-keeping requirements are just massive.
This table really shows you how the rules are a moving target. Just look at the shift from the current Section 48 to the new Section 48E that kicks in 2025. You can see that some technologies, like nuclear fission, suddenly become eligible for the very first time. But at the same time, others, like combined heat and power, get phased out. This adds a whole other layer of complexity, especially for long-term project planning. So with all this opportunity and all this complexity swirling around, what's the single most important next step? Well, it's all about getting the right expertise on your side.
Claiming the ITC isn't just about filling out a form. It's a highly specialized skill. It sits right at this weird intersection of super complex tax law and really detailed engineering specs. You have to understand both of those worlds, inside and out, to maximize the credit and, just as importantly, minimize your risk.
What this really means is you absolutely need a multidisciplinary team. As you can see here, success really depends on this coordinated dance between your legal counsel, your tax advisors, your facility managers, and your engineering consultants. They all have to be working together to navigate this stuff.
Look, at the end of the day, the ITC is a massive financial opportunity to accelerate the clean energy transition. But it demands incredibly careful planning and really deep expertise. So the real question you should be asking yourself is this: when a challenge is part engineering and part tax law, is your team truly ready to capture its full value?